Hello everybody. Before I go too far into this, can you just let me know if the sound is okay? If it's too loud, too quiet, or just right, if you could let me know. Why? Okay, that's great. So welcome to the second Q&A. We did one earlier when I had to actually record the Q&A. We had a bit of a problem with the live feed, but now we've got the live feed. First of all, before we talk about anything else, let's talk about the disclaimer. So what I am going to talk about today is trading, and obviously if I talk about trading, it's kind of easy and hard to talk about in generic terms, but I'm going to have to talk about it in terms of what I do myself and my own risk parameters. So you have to take that in mind whenever you hear anybody talk about their own trading. Please understand they're talking about the way they trade and their own risk profile, which might be different from your own. So whenever you hear anything about trading, you've always got to kind of fit it back to your own scenario. So what we're going to do today, we're going to do a Q&A, which means shortly you can just ask any question. Doesn't really matter what it's about. We haven't got any limit. But one of the first things we're going to look at is trading plans and the educational material from Jigsaw. Now, one of the things that you might know or you might not know is I do encourage people to send me their trading plans. So sometimes people will say, I'm struggling with trading, and they'll be a little bit vague about what they're doing. And so I'll say, can you send me a plan? And I don't really do that because I'm altruistic. It's basically something I feel that needs to be done. If you're in this industry, you need to understand what people are doing and what they're struggling with. And so I get a lot of plans, and some of the plans I'm seeing lately, seen some just in the past couple of weeks, there's some stuff missing from them that perhaps I think should be in the plans. Now, obviously, there's no outline saying all of these elements should be in a plan, but there's some common elements that I really think should be in a plan. And so, if you're going to send me a plan, or are you going to do a plan yourself, there's some things I want you to consider putting in them that will make them more complete, not just for me, but for yourself, so that you actually understand what it is you're actually doing yourself when you're trying to follow this plan. And I also get a lot of questions about the educational material, and there is a lot of material now, and it's probably a good time to actually go back and look at the training material and say, well, what is it, and what's a good way to get through it? Because I don't want somebody sitting there through 15 hours of videos thinking they need to watch 15 hours of videos to trade. Trading isn't that complicated. Trading isn't 15 hours of rules. There's a lot of duplication in the videos and just looking at the same thing in different ways. So we're going to go through that. What I'd like to do is keep this informal as well. So as we go, you can ask questions related to the topic we're talking about. So if you disagree with something, that's fine. Or if you want to ask a question about something, that's also fine. So feel free to interrupt. I do have my eye on the questions. So we're going to look at first, what is an edge? Because I've had that discussion with one customer this week. What is a trading edge? Then we'll look at what people miss from their plans. Then we'll look at the educational material. So a trading edge. So this is something that people talk about. And, I've got my edge, or, oh, my edge is this or my edge is that. And people tend to talk about trading edge in vague terms. They've either got one or they haven't got one. They don't really tend to say what their specific edge is, or what an edge is even. So I think for a lot of people, this concept of having an edge, or what is an edge, it's become a bit of a mystery to a lot of people. And it's almost become like the secret sauce of trading, where a lot of people think they haven't got an edge. I'm trying to do all these things to decide when to buy and sell. And I'm doing all those things, but I still don't know what the edge is. What is this edge thing? I mean, for somebody who's profitable, when somebody's profitable, I'm looking at somebody who's profitable. I'm not profitable myself. I'm looking at somebody who's profitable. Those guys have got an edge, and they know what their edge is. And it's like, well, if they've got an edge and I haven't got an edge, it's like, what is it they know that I don't? So for a lot of people, I can see they're struggling with this concept of an edge. And one of the guys this week, came up and said, well, what do you really mean by an edge? So let's first of all consider just this first paragraph. So when you buy a market, you only make money if other people buy after you and the market moves up. Makes sense. You only keep that money if you get out of the trade before price comes back at you. And you only make money overall if you can keep more than you lose. Pretty obvious stuff. And I think everybody would say that is reasonable. Now, somebody's asking if I'm muted. No, I'm not muted, Don, but I'm presuming you can't hear that because you think I'm muted. So anyway, that's a reasonable thing. You're going to buy a market. If you're directional trading, you're buying a market because you think other people will buy after you, okay? And a lot of people approach the market initially looking for a mechanical system. So they'll start with a bunch of technical indicators and they'll look for a combination of indicators that worked in the past, which they assume will work in the future. But that study of those indicators, that approach, actually didn't do anything to identify why buyers would continue buying. So what are those buyers actually doing? So are they speculating or gambling? We could call it speculation, gambling, which is what most people here are trying to do. So you're trying to speculate, you're trying to money, you're effectively trying to guess the direction of the market and make money if you're right, okay? Are the people that continue buying after you, are they trading longer term? Okay, so are you trying to make money from investors? Are the people that are going to be buying after you, are they people that are getting stopped out? Because those are the kind of things, those are the kind of activities you're going to make money from. So if you believe that at a certain point in time, a bunch of speculators are going to come into the market and that's going to drive the market in a direction, that is an edge. Knowing that is part of your edge, right? Now, what you can't do, and one of the things, reason I didn't reply to the, I'm not sure if Chris is here, but one of the reasons I didn't reply to Chris's email about this edge and about what my edge is or what an edge is I don't want somebody to just copy what I'm about to say. So don't just pick one of these. Don't just say to yourself right now, okay, longer term traders, I'm going to make money from longer term traders. They are my edge, right? So you can't just pick one because I've said it today and then say my system, look, my moving average crossover works because when those two moving average cross, I'm getting in because people are long-term trading. Because that's not a reason. You actually need some kind of evidence or a theory. You need a cause. Okay, now an example of a cause would be an area of high volume. Certainly has, if you've got an area of high volume, you've been sitting in a trading range for a while, there is a cause above and below that trading range. There are stops that will fire when we break out. A level that's very obvious might also be a cause if it holds. So if a level holds, sometimes if you're very common level that a lot of people are looking at holds, speculators will jump on board and push the market in a certain direction. So you're looking for a cause, right? Now, a lot of people will say, well, that seems very, very advanced. Okay, so I've been looking at the market very technically. I've been looking at moving averages. I've been looking at Ichimoku clouds. I've been looking at MACD. I've been looking at stochastics, whatever. That's very technical. And then you say, well, now I've got to think in these very different terms of why are other people going to behave in a certain way? And to many people, that's going to seem a little bit scary, but it's only scary because you haven't actually started looking in the market that way. And the one person that you can probably take a lot of cues from in terms of the way other people are behaving is yourself. So you're a speculator, and a lot of the people that are in the market, so a lot of the times the markets like the S&P 500, crude oil, is purely 100% speculation, okay, or near enough, basically. And if you think that that market is nearly 100% speculation, and effectively most of the people in that market are trying to do what you are trying to do. And if you can put yourself into that mindset and try and start looking at the market from that mindset, then you will start actually to develop this skill of actually understanding causes, understanding why people are getting in. On a low volume day, why is the market really got no direction? Why does the ES swing one way for 15 points and then, for the first couple of hours, and then swing the other way 15 points for another few hours, and then swing back and end pretty much where we opened? Why does it do that? It's purely speculation. Okay, so your edge is effectively the way you're going to recognize that people are going to start buying or selling or continue buying or selling, right? It doesn't have to be all about reversals. So your edge is how you're going to recognize that the market's going to behave in a certain way, and then how you're going to actually capitalize on that, how you're going to actually make money from it and not give too much money back. Now, one of the things about a cause is any particular cause is going to have an effect. But that effect, there is a scope. And one trader always remember one trader told me he always thinks about the scope of his signal. So he has a signal to enter the market, but that signal has a scope. It has a finite effect. It has a finite amount of time that particular event will be impacting the market. So if you think about something like a stop run, so we have an area where a lot of traders engage in the market, and those traders get stopped out, it's not going to cause a 50-point move on the S&P 500. It's not even going to cause a 50-point move on crude oil. Okay, so when you look at your cause, or look at the thing that's causing other people to behave in a certain way, you also have to think about how long will they keep behaving that way. So on a stop run, really on the S&P 500, normally on a stop run, you can't really expect much more than 5 or 6 ticks out of that stop run. Now there may be continuation afterwards, and you may have a reason for that, but part of the analysis of the cause is also the scope of the effect. Now, obviously, if you don't understand the cause, you're not really going to be in a good position to identify how long the effect will last. So if you're not looking at the market that way, in terms of how other traders participate, it is going to be a struggle. Now, that doesn't mean that you still can't lean on certain technical indicators. I mean, I use a cumulative delta, for instance, which is net buys minus net sells. But I'm using that to try and figure out which side on the market order side is kind of in control right now. So looking at the market in terms of activity of traders, long-term traders, short-term traders, people getting stopped out, that kind of thing, is what you need to do, but it doesn't mean you can't use technical tools, okay? Now, the interesting thing is that the people that are new to trading that think a pure technical approach that just studies price-based indicators, they think that's the easy way to decipher what's occurring in the markets. But the actual fact, if you decide to look at the market in terms of other traders' behavior, it will all start to make a lot more sense. So in terms of an edge, that's all it is really. You need people to do something after you get in, and you need to stay in long enough that you're actually going to capitalize it. So you need to know what's going to make them react, and you need to know how long they're going to react. So that's basically my explanation of what an edge is. So if you're putting a plan together and you're going to send me that plan and it says I'm going to buy when this line crosses this line and I'm going to sell when this line crosses this line, the question that you will get back from me is, why are other people going to react the way you think because those lines cross? Now, if you've got a good reason for that, that's your edge, yeah? So I don't know every reason myself, but if you don't have a reason for that, if you've just got these lines crossing, it's very, very unlikely you've got any edge over the market, because you're trading something behavioral based on something that's just fairly arbitrary. Okay, so that's the edge, which is probably the most important part of your trading plan, is understanding why you're making money. Now, if you understand why you're making money, when you stop making money, you will understand why as well. Now, every trading plan is unique, and there's nothing to say that every plan must have all the elements that I think should go in a plan, okay? But people are sending plans to me, so I'm going to tell them what I think should be them. But most of the plans that come across my desk would really benefit from the addition of just a few elements. So the first one, I'd call it a panic button, okay? And this is essential. So let me give you an example. A lot of people know that I like to use cumulative delta to set overall bias. And if you've been looking at that too in the past few weeks, you know that we've had quite a few days where the cumulative delta has been useless. Now, on those days, I could do one or two things with that cumulative delta. First of all, I could try to figure out what is wrong with my understanding of cumulative delta that causes me to not get anything from it on those days. So I could try and become the Zen master of cumulative delta so that I understand it every day in every way. Or, alternatively, I could say cumulative delta is not much use today. And it's my belief that the latter is the right thing to do. So you accept that nothing works all the time, and there's sometimes where you just got to stop using stuff or just ignore stuff. So correlated markets again, are something that are great. And a lot of people for a long time used to trade the ES and look at the treasuries, and if the ES and the treasuries were doing opposite things, that was fantastic. But if the treasuries were going up, you wouldn't buy the ES. Now that doesn't work so well nowadays. It just stopped working. So you could beat that to death, or you could just drop it. And the same should be considered about your overall strategy. So sometimes the market's just not going to be compliant. Sometimes that is because the volume's too low, and quite often we had a day a couple of days ago. The volume was that low, and it just seemed so random. And I think it was Monday actually. And other days, there's not enough speculators in the market giving us direction. So on those days, if you keep trying to trade that market, like Monday, certainly Monday, if you'd have kept trying to trade, and certainly the way I trade, if I'd have kept trying to trade Monday the way I normally trade, I would have just kept losing money basically, because it just wasn't moving the way I like. Now I was lucky enough on Monday that I could recognize that ahead of time, and that's just an experience thing. But on those days where the market's not cooperating, your goal should be to stop trading as soon as possible. So I can tell you, I stopped trading on Monday, and I went into the Jigsaw chat, and I saw one of the traders that had stayed in the chat room. I saw his comments on Tuesday morning. He'd had an awful day basically, and what he'd been doing, he'd been trying to just carry on and kind of almost like tough it out basically. So one of the most important things in your plan is having a panic button, something like 3 losses in a row and I stop, just so that on those days when it's not working, you just stop doing it basically. And it doesn't mean there's anything wrong with what you're doing. It just means the market's not conducive. I mean, if your plan works on 95% of the days by either giving you decent trades or enough decent trades, or keeping you out of the market, then on the 5% of the days it doesn't work, there's not really that much upside in trying to beat the market with a stick, trying to make your plan work. So you've got two alternatives. You can carry on making losses, or you can just say, okay, I'm out. And I guarantee if you carry on, it becomes very, very frustrating, because we've all done that basically. Now the second thing I don't see is really anything related to the state of the market or correlated market. So what I tend to see, when this happens, do this. When this happens, do this. And it's just the strategies, same strategy, cookie cutter formula, going to do the same thing every day. Now there's lots of ways to assess the state of the market, and I'm not going to go over all those, but what I would say is the reason for doing it is more important than the actual techniques you use, because there are lots and lots of things you can do. So, for example, we often get one-way days where the market moves one direction pretty much from the open, and we don't get many pullbacks. Now, on those days, you have to jump on board moves, and if you were trading reversals, it would be very, very damaging. And then other days, we get low volume, low range days, typically in the summer, where there's no trend. And if you try to just jump on board that, you would also get hammered basically. So fading moves or trading reversals is the only real option on those days. So you've got two extremes of market conditions where you have to apply the opposite strategy. So on a strong trending day, you go with the market. You do not fade the market. You don't trade reversals. On a really low range day, if you go with the market, you're going to end up buying the top. You have to fade the moves. Okay, so if you don't understand the state of the market, you don't really know how to trade that market. And we get lots of shades in between those two extremes. So, not just looking at the state of the market on only one day, the market changes pace throughout the day. We all know that. The market will move, then it will, especially on the S&P of late, it's been putting in maybe a little bit of a move off the open, and then it's been churning around for 2 or 3 hours. And because we build so much volume in that area, market breaks out and we hit a run. So the market's going to change pace throughout the day. And you need to just keep an eye on that. It just needs to be a part of what you do as much as looking for an entry. So what helps you monitor the state of the market? Increases and decreases in volume. If less people are playing the market, right, it's going to be a little less directional. If a bunch of people come in, they're coming in for a reason, it usually gives the market a bit more direction. Increases or decreases in market depth usually give us more volatility. So if there's not so much market depth, there's not so much liquidity to eat through, the market's going to whip around a lot more. Certainly it's going to affect the size of your stop losses. Now, correlated markets moving in sync or doing their own thing. So a good example of correlated markets moving in sync would be yesterday. We had a bit of a slow start on the S&P 500. Market broke up. The Dow, the Nasdaq, and the S&P 500 all moving together. Okay, very good thing to see. Today, earlier on, we saw what? We saw the S&P was kind of mulling around. The Nasdaq was at its highs. The Dow was about just under halfway, just under the halfway mark for the day. So we have three markets that when we start to have a good move, they'll all start moving in sync. And then when the market kind of dies and there's no direction, they'll all start doing their own thing. Okay, so correlated markets are a good thing, but just bear in mind there are things that will stop correlated markets working. So things like if you're using the interest rate futures, things like that, just the stuff that's going on with interest rates now is going to affect those correlations. So those correlations, correlations with currencies as well, they'll work for quite a long time, and then sometimes the correlations will break down forever, and sometimes the correlations will just break down for a particular day. And again, if it's not helping, then you just try not to look at it for the day. Now, the other thing, also market internals, I like to use the NICE tick or an average of the NICE tick. That's really the same thing as a correlated market, basically. It's just looking at the S&P 500. Now, price-based indicators will not tell you that the market state has changed in time. And there's been, on internet forums, I've seen quite a lot over the years of people saying, I want to write an indicator that tells me whether the market is ranging or trending. Okay. Now, if you could do that, that alone would be enough to make you profitable, right? So even though it doesn't sound like it, it is the Holy Grail. Okay. It is pretty much the Holy Grail. So you can't have something that will tell you all the time. And generally speaking, anything that's indicator based will tell you late. But what you can do is, keep an eye on certain things, certain other markets. Generally speaking, you'll be looking at the market depth in your market. You'll be looking at how active correlated markets are, and you'll be looking at the volume increases and decreases. And that will give you enough of an idea to decide which strategy to employ. Now, you might have other things that you use for market conditions, other ways of identifying what the market conditions are. Doesn't really matter what you use, just really matters that you do something, that you've always got in mind that this market can break now or this market can slow down now, and you always have that in your mind to adjust. Now, the other thing, the entry type, okay? The type of order is important. So again, I see a lot of plans that say, when this happens, I'm going to buy the market. But you can't just buy the market, because at any one point in time, there's always two prices in the market. So there's a price that you can buy at market, the inside offer, and there's a price you can sell at market, the inside bid. And of course, you could join the bid or the offer too. Now, if you buy at market, you stop, and your stop is 4 ticks. That stop is 4 ticks from your entry price, but it's 3 ticks from the inside bid. Okay? So that effectively means that if you buy at market, your stop is 1 tick closer than if you buy at a limit order. So if you buy at a limit order, you get an extra tick breathing room. And we are talking in this room probably a lot of trades that are aiming for 4, 5, 8 tick stops. But the downside of entering at limit is that you do need the market to continue trading against you to fill your position. So if you're a momentum trader trading into momentum, getting filled on a limit order on a market like the S&P 500 is going to be tough. On a market like crude oil, you've got a decent chance. So you have to kind of put that into perspective. You do need certain things to happen to get in a market, but it also means, you've got to get the fill. Okay, taking a limit order does mean you have a chance of not getting filled, but you're effectively an extra tick away from your stop. So you can't just put, when I see this, I'm going to buy. You have to specify how you'll buy, when you would get in at the market, and when you would get in at a limit. And in addition, you got to think about how you're going to handle your stop size for entries where you're getting at the market, because just because you bought at the market doesn't mean you necessarily want to actually have a tighter trade. Okay. Now, the other part of that, it's really about the same thing, is expectancy. And this is one of the things I had a chat with a trader today. And this is kind of mathematical. So part of your strategy is going to be to track the results and see how well your strategy is doing. But there is something you've got to understand about the results and about trading randomly so that you understand whether your results are actually do have any edge in them. And I say that because you might have what appears to be seemingly good results, and you might feel that your results just need some minor adjustments, but there may be no edge in them. So if you look at this example here, a 9-tick risk and a 1-tick reward giving you a 90% win rate. What that means is if you enter any market at random with a 9-tick stop and a 1-tick target, then over time you will win 90% of your trades, okay? You will not make any money, okay? And it just means that in a random market, in a market that's moving randomly, the probability of it moving one price moving one direction or 9 prices in the other direction, you're going to have the moving the 1-tick direction 90% of the time. Okay, just sheer probability based on randomness. And obviously that will be over time. You might get lucky with a few trades, but over time, with a 91 risk reward, you're going to win most of the time. You're going to have no profits, okay? But it would be easy to look at a result with a 90% win rate, but break-even results and think, man, I just need to make some minor adjustments and I can get this to profitability. And a lot of people come in saying, Pete, I'm nearly there. I just need some tweaks. I just need the order flow to kind of help me refine these entries. And of course, if what you're looking at is effectively the same results as what you'd get from random entries, given your risk reward ratio, it is not possible that making a minor adjustment with order flow will make it profitable, because effectively there is no edge in what you're doing. And I know that sounds really terrible and really harsh, but if your results are exactly the same as tossing a coin, then you might as well just toss the coin and not put in the hard work. So when you write your plan and look at the results, you have to compare those results to pure randomness just to validate that in fact there is some edge in what you're doing. Now, there is a famous book, I can't remember the name, it's a very famous trading book that shows the results of a random entry trading system that used a trailing stop. And it showed that over time, entering the market at random made money with this system, okay? Now, the authors, though, were rather disingenuous in trying to prove a point. What they had, effectively, was a trend-following system. So it's random entry with a trailing stop, okay? So if you think about it, counter-trend trades would be stopped out almost immediately. The trades that were with the trend would run because of the trailing stop, okay? Now, if they'd applied that system to a market that wasn't trending over the test period, they would have lost money. So again, it's all about not kidding yourself. There is an edge somewhere that there might not be, okay? Now, somebody says, can you please compare unfiltered recon tape and the tick index? Okay, let's just have a quick look at those two. Okay. And we'll get the recon tape. I haven't got an unfiltered one. Okay, so the tick index here, this doesn't look like the nicey tick to a lot of you because I use an average. Using that, basically, what I'm using that for is just to see if there's any direction in the market. Now, if we can maybe just have a look where it's done today. So this is the S&P 500. It goes up if one of the 500 stocks is ticking up. Oh no, it's the NYSE, New York Stock Exchange, sorry. So it basically, for every stock for that minute that's ticking up, it's got to the upside, and every stock that's ticking down to the downside. So basically, if it's above the center line, we've got more stocks moving up than down. And what you can see on this day, you could probably say that after 10 o'clock, there was a slight edge to the upside, but really nothing. And then on strong trend days, you'll see much bigger peaks and much more consistency on one side. So really, if you look at the NYSE tick, you're looking at kind of an overall big picture view of where the market's going. When I look at the tape here, I'm really looking at individual trade sizes to see if large trades are coming in against. So it's two, I can't really compare them. It's just two very, very different things. Okay, I am just showing this. There's not many slides here, Carl. Carl's asking if I'm showing different slides. Okay, Chad's asking if I have plans to create an order entry to send a buy orders to the market when the inside offer decreases to zero. There is going to be a volume stop. That's going to come in lately. Claudio, to get the chart, just send me an email and I'll send you the indicator for that chart. Okay. So the next one is a bit similar to the market state, and it's the volatility changes day to day, okay, and the changes intraday. So we may have similar market condition, a regular day trader's day where we've got mostly speculation, but on that particular day, at that particular time, the actual intraday swings are much larger. So a lot of the plans I see, they have a lot of criteria for entering the market, but very few for exiting the market, or the exits are fixed, a fixed target and stop. So if your stop is closer than your target, right? So think about this. If your stop is closer to your entry point than your target, if the volatility increases, it will cause you to get stopped out more, okay? Now, there's a scope. So if you think about it, if on average the volatility is like 4 ticks per second, right? And then the volatility increases to 20 ticks per second, right? You might get away with your 8-tick stop when the volatility is 4 ticks a second. But if the volatility changes for 30 ticks a second, then the chances are your 4-tick stop will get taken out. So you move, by the volatility increasing, right? You move from having a system with an edge, right, that now is going to hit your stop just because volatility increased, and that just general randomness, that just general wiggle in the market increased to the point where it became very likely for your stop to get hit. So basically, it's very, very important to adjust for volatility. So you can be right about the entry, but if you don't allow enough wiggle room or breathing room for the trade to work out when volatility increases, you're just going to get stopped out more, and it would be very frustrating. You could get stopped out 100% of your trades. Okay. Now, the last thing we're going to talk about is the logging, because again, one of the things most people don't include is how they're going to record the results. And maybe you can say that shouldn't be in a trade plan, but certainly the people I spoke to didn't really have any plan to log the results. And a lot of people that come to me, they will say, oh, I keep losing. Have you got a plan? Oh, no, I'm not ready for that yet. And it's like, well, if you've not got a plan, do you actually log the results, what's working and what's not working? Well, I haven't really got that after. So if you don't have a plan, you're not going to do the same thing over and over again. If you don't log the results, you won't know what's working and what isn't, okay? Now, this does not have to be something exotic. Simple spreadsheet will do. You need to log what you did, which of your trades in the plan you're taking. So with a trading plan, I would expect you to have multiple different trades that you take and that you add those trades over time. So you might have certain trades you take in range-bound markets. You might have certain trades you take if the market is now trending and we've started to build volume in an area. You might have certain trades you take when the market's moving one way and not pulling back. So you need to specify in your log which of those trades you took and why. And you should also log how well a specific trade followed your plan. Because what you're going to do if you're normal is you're going to take trades in your plan, but you're going to ignore certain things that are in your plan. So you might say, well, the Dow and the Nasdaq are going down, but I bought the S&P 500 anyway, even though your plan says it didn't. And it's kind of important because if you find that your plan works really well, except on the times that you ignore the correlated markets, that should be enough to actually teach you not to do that anymore. Okay. You also might find that some of your bad behavior could actually be having positive results. I know some people say this is bad, but at the end of the day, if you enter the ES long, and you take your trade when the Nasdaq and the Dow are moving down, and that keeps working for you, then obviously that's telling you something interesting as well. And that's maybe you should try and figure out why that's happening. Okay. So this is your feedback loop. It's the place where you're going to see how well your plan does in execution, and it's the basis on which you can make adjustments. And I know that most people think it's unnecessary to do this, and most of the people that tell me it's unnecessary and that aren't doing it are traders that are asking me for help. So people come to me and say they need help, but they can't really tell me what they're doing, what's working and what isn't. They just know they haven't got it, and as such, it's really hard for me to help them. So the other thing you've got to remember is that logging is difficult for a number of reasons. So first of all, it's very difficult to find the right balance of actually logging your trades in time, or actually putting enough information and not actually detracting from your trading. So if you're a short-term trader like me, I want to get into trade and I want to try and take some profit at 4 ticks. And I really want to micromanage the early part of that trade so that I don't let the market move too much against me. And so if I take a trade and I'm trying to watch that, it's very, very difficult to then at that same time write in all the reasons for taking that trade and exactly how I felt when I took that trade. Flip side is, if you do it afterwards, if you do it too far afterwards, you will lose some of the information because you won't really remember, how you felt. You won't remember what was the NICE tick doing at that point, or what were the Dow and Nasdaq doing at that point. So basically, you will lose a bit of quality, you lose a bit of information. So I think what you have to do, I would recommend writing it down and not typing it in on the computer because you've already got your PC set up to trade. So for me, I always have I just keep a little notebook. People buy me diaries at New Year's and Christmas, and people, you get all these free diaries from Starbucks and stuff like that. I use those basically. I just use those, and I've just got a shorthand for what I write when I take a trade, and I find that kind of does it makes it a little bit more difficult to go over it afterwards. But if I keep my PC for the trading, keep my little Starbucks journals for the log, then I get along with that. So it's a long-term friend, but is a short-term enemy because basically you absolutely should expect when you start logging to not enjoy it, because effectively what you're going to be doing, if you're actually losing money now and you're trying to implement a new plan, you will initially be recording a lot of losing trades, and it's not, I can tell you from my personal experience, there was no fun in it. And my personal experience is that I kept stopping my log. I kept stopping writing to my log, or I would decide that certain days I'd just gone off the rails and I wouldn't put that day in my log. And I think that's one of the reasons a lot of people stop, because it really isn't very nice to do something stupid, right? Or to do something that's off plan, to lose money doing it, and then to have to write it down afterwards. It's kind of adding insult to injury. But I would say the plan itself is probably more important than the techniques that you use. Okay, because so you could start off with any trading technique, and if you get into the habit of logging the results, you get into the habit of reacting to those results in a pragmatic way, actually going over the results and feeding back in the plan. If you can analyze the results of your trading and make sensible adjustments, and then analyze the results of those adjustments, you've got a much better chance of making it as a trader. Simply because you're not relying on your gut feel at the time of having money on the line. So, if you don't log, what you're really going to be going on is kind of that gut feel at the time you've got money on the line, and that really isn't the best guide as a trader. Now, in terms of logging, if you're trading, I don't know how long you guys individually have to allocate to trading, but if you're trading for like 4 or 5 hours, if let's say you got 5 hours to trade, I would say probably cut that down by an hour and spend an hour to review afterwards, and try and give yourself time that way. So don't try and make it extra time on top of what you're doing now, because otherwise you're going to give yourself an excuse, so there's not enough time to do it. The trading part is a lot more fun. The trading part is a lot more fun. It's nice to be engaged with the market, but it is a business, and if we want to have fun, let's go to the park, play on the swings for a couple of hours, and then come back to trading. Okay, so that's basically my thoughts. You are more than welcome to send your trading plans to me. If you feel they're ultra secret squirrel, then obviously don't send them. If you're not sure it looks like a trading plan, or you just want a second pair of eyes, I'm more than happy to take a look for you. Okay, so at that, let me go on to the next topic. If we've got any questions at that point, I think we're okay for questions. Okay, let me move on. Your goal is to have a goal, Carl. I think that's a smart thing to say, Carl. My goal is to have a goal. And I think initially, if you haven't got a goal, maybe the first trading plan is to actually, put down what you're going to do, see how well it does, and then try and figure out where you need to go with it. Because, what Carl's saying, my goal is to have a goal, is probably a good point. Because, who is going to tell you how well your strategy is going to perform? Who's going to tell you how good a trader you can be? We know probably some things, 1,000% a week is probably unrealistic, but don't think that you should be experienced enough to set a goal You might have to get some feedback, see some results before you can say, okay, this is where I think I can take this. Would I consider today to be a low volume day? Looking at the CSI, well, let me just pull up the CSI. It was low earlier, and it's not getting any better. So let me just explain this. CSI, this is a technical indicator. What it's doing, it's comparing the average cumulative volume. So the average volume for the time of day, and comparing it for the average volume for the same time of day for the last 60 days. So what we can see here is volumes dropping. It's dropping relative to where it should be for the day. So effectively, this is a low volume day. The volume is really tapering off. So we see the days where the CSI is to the other side. We can get a lot more direction. It can still swing around because the S&P does tend to run one way than the other. But yeah, this is a really low volume day. I mean, I put in my prep earlier on that it was low volume coming in. I think we're 100,000 contracts below average as we came into the market. But yeah, low volume day. Day where we could have played the volume range at the value area earlier on. I don't know what it's been doing for the past hour or so because I've not been watching it. How do you get it again? If you want these charts, the actual charts are on one of the Jigsaw courses. But if you want to email me, I'll send you. It's the CSI. It's the Cumulative Sheep Index, and we'll take a look at why in just a second. So let's have a look at the education. Because again, I get a lot of questions about the education material on the site. And I just want to give you an idea of what it is we've got on the site, what might be useful. So first, let's take a look at the resources on the education page. So we've got a page, it's Learn to Trade, free order flow lessons. Just bring it across. 1 second. Okay, so free order flow analysis lessons, and what a nice guy to give all these free lessons, a lot of people said. And unfortunately, this isn't because, I would love to say this is because I'm a nice guy. The reason these lessons exist is mostly because I don't want to keep answering the same questions over and over again. And I found I was doing that, and I found that by creating this stuff, people could come here and then find out stuff for themselves. So what I'm going to do, I'm going to take a look at the resources on this page. This page is free to everybody. You don't need to be a customer to access this. Some of the information here is about the theory of order flow, and some of it is about the practical application of order flow. Now, you don't necessarily need all of the theory to be able to trade with order flow, right? I mean, I go into stuff like what are the pros and cons of footprint charts versus cumulative delta. It doesn't really matter. It's just, I like to put the information out there. So we'll try and figure out what's the minimum, okay? So the first one we've got is this new to Jigsaw tool. So this video is for people new to the tools, and it's to give you an approach to learning order flow that you can build on. So you start by looking at the most important and most useful information, and we give you drills to go through. So what it's doing, it's effectively saying, right, when you start with order flow, just look at this and don't look at anything else, okay? And if you do those drills, you will start to make major steps forward in hours, okay? And we recommend you can do 60 to 90 minutes at a time, and maybe 1 or 2 times a day. Certainly not more than that. Unless you've got like a massive, unless you're on Ritalin and you've got a massive attention span. But with any new skill, it tends to be quite tiring. So once you've spent 60 minutes looking at order flow, for most people, you probably want to start getting a bit of a headache. So if you do those drills, you're going to make major steps forward in hours. Now, that's not going to be consecutive hours because you can do it twice a week. So it's going to be maybe like 4 or 5 days' time. You're still going to start to see things that we're telling you to look for, and it's going to give you that, now I understand. Now, it's not going to make you an expert in order flow. It doesn't give you any of the theory. It doesn't tell you why at all. It doesn't say this is why these things are happening. It just says look for these things. And it does give you things you can use. Now, lots of customers that buy the tools do not follow this when they start because they just want to dive in and start trading with the tools. But I know guys who bought the tools 6-9 months earlier that just didn't get anywhere and went back to this video and finally saw it. So, even if you've had the tools for a while and are struggling, just go back in this video and just have a leap of faith, because we just found over time, telling people to kind of take different approaches, we just found there was a certain approach, certain way to look at the market. And of course, we borrowed a few things from the way that prop firms trade. This isn't all everything's, invented by us. But we think we've got a really good method to get people going. So that's what New to Jigsaw Tools is about. If you already know how to read the tools, probably don't need it. Then we've got this thing called the Order Flow Foundation course, and that's a series of videos, excuse me, starting with the theory and then kind of moving into practical application. So the first one, Introduction into Order Flow, that is pure theory, right? This is theory of order flow. What order flow is all about, why order flow is relevant, okay? It also talks about the fact that all order flow tools are basically a variation on the same theme. And we look at different order flow tools and we show, okay, this is what you're seeing on this tool, and this is the way you're seeing the same thing on this tool, and this is the way you're seeing on the same thing on this tool. But different tools give you different horizons as well. Now, the most important part of this video is the first 35 minutes where it talks about the concepts of liquidity consumption, okay? And that is the mechanics of price movement. And that is something that every single trader should understand, okay? How price gets from one point to another point, okay? And how and what's stopping it, going from another point. So we go over that, a number of order flow tools. We discuss the pros and cons of each one. We're not just saying all the other ones are bad, Jigsaw's good. We actually, because I do use cumulative delta, stuff like that. I would use footprint charts if I thought, it would be used to me. So we will look at the pros and cons of each. But basically, with Introduction to Order Flow, first 35 minutes, if you haven't watched it, it's really worth watching, okay? The rest of it really doesn't matter if you watch it or not, okay? Practical application of order flow is the second. And we look at various ways here you can apply order flow information. So, for example, using the order book to predict a volatility change. The art of scalping and why, for some people, that's a good place to start. We also look at using a volume profile and the concept of temporary value. We look at trading into stops, identifying stop locations. And we also take a look at the role of intuition or feel in trading and trading off order flow. And then we look at how the prop shops teach their intern traders to read the order book. In other words, how the prop shops get their traders to have that feel. We then consider at the end, we look at reversals, momentum, spoofing, and how that's going to impact you as you trade. So again, it's not essential that you look at this for your own trading. It's probably just some stuff that you could learn. So if you wanted to watch this, if you just bought the tools, you wouldn't need to watch this before you start using the tools. You might want to say, well, I might be interested in that, and just watch, 20 minutes a day, for a week or so. The third one, introducing order flow to your trading. Basically, that's us trying to get you to figure out where to start adding order flow to your trading. So a lot of the people come to us, they've already got some kind of method, and they come to us wanting to refine the way they enter trades, okay? Now, that might not necessarily be the best place to start or the most profitable place to start, but this video takes a look at, okay, you've already got a way that you trade now, you've got this thing called order flow, how are you going to put those two together without negative impact, okay? So if you're going to start, if you're already doing quite well right now, you don't want to take order flow and then mess it all up. And that is a possibility. That is an absolute possibility. So we look about how not to mess up your trading by bringing order flow in. Where to start as well. So one of the most profitable places to start with order flow is in reading momentum and managing trades. We also consider crowded areas, areas where a lot of people are trying to engage, and we compare them to quieter areas that are easy to read. Because, when you come to this with your method, you might be trading areas where there's a lot of people trying to engage, or you might be trading areas where nobody else is really trying to get into the market. And it's very different in terms of reading order flow if you're doing one or the other. We build a little bit more on the discussion about stops from the previous video, and we look at something called stop cascades as well. And we also take another look at gameplay in the market, mostly not because you want to take advantage of people playing games in the market, but just because you don't want to get caught on the wrong side of it. So from these three videos that we talked about, I'd say the first 35 minutes of the introduction, the first video, is the priority. Other stuff, you just really take your time over, just come back to them when you've got a bit of free time. Now, this is an interesting video, day trading without charts. This is more of a focused webinar. This is technique, right? So the day trading without charts is always funny because people always think that this is, oh man, day trading without charts is like boxing with one hand behind your back, standing on one leg for an hour, touching your nose and rubbing your tummy or whatever. So day trading without charts isn't like a challenging thing to do. We're not trying to do something without using charts. We're not saying no, charts are easy. The trading without charts is like a special skill. It's just about volume profile analysis and practical application of volume profile analysis. And we did look at it in one of the earlier videos. So there is some overlap with one of the earlier theory videos. This is all practical. So we look at how the volume profile builds in both trending and ranging markets, how to identify where the stops are, how to identify future short-term imbalances that will give you a low-risk entry point to the market. I would also say this video is probably one we should put on the essential list, because the bottom line is the volume profile is going to help you assess where other traders are positioned, okay? And there's not many things in trading that are more important than that. Now, the fifth one on this page, the post-entry trade management, which is also called kill it or keep it. Now, this one was an interesting one. It looks at order flow and other components. So this isn't just an order flow video. It looks at other components alongside order flow that you can use to manage your trade, hence the title, Kill It or Keep It. So there's two versions of this webinar, and they both focus on micromanaging just the early part of your trade. So basically the way I trade, again, this is just the way I do things. I micromanage the early part of my trade. I'm focused on the early part of my trade. I'm going to stay in, I'm going to get out. I'm going to stay in, going to get out. I'm like that. Once the trade started running my way, I don't care about order flow. Don't really care about much, to be honest. So we look at order flow, correlated markets, market internals, trade sizes. We consider all those things. And what we do in the video is kind of a weird thing to do, but basically we take random trades and then manage them to ensure that the losers get cut. So basically, I'm not sure, I think in the one webinar we just asked people to call out trades at random. The second video takes a lot more trades than the first. So with this one, you could watch the first part of either one of those videos, but then just watch the trades from both. But basically, it's the same concept. It's a bit like, following momentum. It's just trying to get an idea, is the market on my side once I'm in the trade, and at what point am I going to decide to cut the trade? So, the trades that we took in the videos were all different because obviously we didn't know what was going to happen. So there's a little bit different for each of those trades. So again, if you're looking to use order flow to manage trades, which I would recommend, it's much more important that you watch this video of post-entry trade management than one of the first three parts of the course, which is on, more theoretical. Okay, trading the summertime chop. Again, this is a video you'd probably just want to watch at certain types of the year, because we look at the kind of trading that we see in the summertime and the Christmas holiday. Because what tends to happen is the markets, anybody that's been trading more than 6 months, well, maybe more than a year now, because we did have a good winter, but the markets tend to slow down. So at the summertime, volume and volatility reduces, and so your trading has to change. And again, this is focused very much on volume profile, but it is very specific to low volume, low volatility days, okay? So there is no point you watching this video right now. As we get into, July, August, and the market slows down, come back and have a look at this, because it actually gives you some techniques to trade these markets. Now there are days where it gets so narrow you can't trade them. But basically, we do generally have, even on a 5-point range day, there are some opportunities. Okay, we're nearly done now, but let's plod on. So this video here, anatomy of a reversal. This looks at reversals, okay? Now, not because you need to trade the high, you need to sell the high of the day and buy the low of the day, because, I call the people that do that perma faders, and I am totally against trying to sell the high of the day and buy the low of the day, okay? I think I've just seen so many traders lose massively through it, but it doesn't mean you can't do it. It just means I've never done it, and I've never really met anybody that could do it consistently enough. What I find that happens is you're trying to buy the low of the day, you've got a few candidates below that could be the low of the day, hits the first one, you buy it, it goes through, hits the second one, you buy it, it goes through, hits the third one, you buy it, it works. Doesn't matter if it works anyway. Best thing you're going to do is make up for the first two trades you lost. So I don't try and do that myself. We all know that, though, that intraday, these markets that we trade, like crude, the S&P 500, even some of the treasuries on some days, on any day, you can't, if somebody comes and tells you, do you think, comes to ask you, do you think the market's going to go up or down today? The answer's got to be yes, probably both, right? Because most days it does both. So you can't come into the market on any one day and say, I think it's going up today. It might end up higher, right? But it might go up 12, down 15, up 16, and that's how it went up. Now, if you'd have gone long at the start of the day, you certainly wouldn't have been long by the time it had gone down, and probably wouldn't be long again on the last leg up, unless you're looking for these swings multiple times. So any day you come into the market, you're really looking for opportunity on both sides. Okay, so we all know that because we all look at these markets every day. Now, in order to capture any part of those moves, you actually need to know when the market is trending, obviously, and how to tell as early as possible that the trend has reversed. So for this, we use the volume profile. We use swing charts, which is basically showing us the volume in a swing, and we use the cumulative delta. Okay. Now, there is some overlap between this and the day trading without charts video, because day trading without charts video obviously has to consider reversals as well. So we do talk about some of the similar volume profile concepts, but the difference is we're using charts as well, and we aren't focused in this video about the entry points that you get off the volume profile. So again, I would say if you don't know this stuff, you're probably at a disadvantage in the markets. There are some things on a lot of days, the market is showing a big red flag. The market moves down, it pulls back. The market moves down, it pulls back. The market moves down, it swings up. And that first swing up, there are some things that the market tells you that is very likely to be the first swing up of a new uptrend. Okay, very, very, very likely. Okay, so if you're trading, you've got to know that stuff, right? It's just so useful, because what I do, I watch where the market's going, I set my bias in that direction, keep my bias in that direction until I see some of these things, and then I think, oh, market's reversed. So, market's going down, I'll go short, go short, go short. Market then shows some signs of reversal, starts going up, and then I'll start going long, basically. So again, if you don't know that stuff, or you feel that what you're doing now doesn't tell you that stuff, really, really worth watching the video. Okay, let's quickly go through some other stuff. This is a great video, first 20 hours. It's my reply to anybody that says it takes 10,000 hours to learn how to trade, because that's a number that gets quoted on a lot of internet forums. That would be 5 years full-time work, and that would pretty much put every prop firm out of business if they couldn't make money for 5 years. So Josh Kaufman here discusses skill development, how we learn, and kind of how we learn at the early stages and the later stages. And it is kind of there is a learning curve, obviously, and how we make progress. So that's an interesting one to watch. Obviously, it doesn't matter whether you watch that one or not from a Jigsaw point of view. Day Trading for Dummies is based on our ebook, Surviving Day Trading, and it takes a look at what trading is, okay? What is trading? And if you've read Surviving Day Trading, it tells you what you're trying to do. What is trading? It's not a bunch of squiggly lines on a chart. You're trying to take money out of somebody's pocket, right? That's what you're trying to do. You're trying to take money off somebody else, which is absolutely fine. But I think it just talks conceptually about what trading actually is. It might sound simplistic, but a lot of people get into trading. They start looking at charts. They start doing this. They start doing that. They don't even think about what it is they're trying to do. They don't think about who's on the other side of their trade. What needs to happen to make their trades work. So again, that's an interesting one, not a very long one either. And then we've got this stuff down here, this tape reading order book analysis lessons. It's like, well, isn't all the other stuff on that? And that is true. What we did in 2011, we had a course, and it was just like a text-based course mostly. That was this was our course, basically, that kind of told you what everything was and how to tape read and what the benefits were. And that kind of got superseded with the videos, but I just left it in there because you might just have a different perspective, what a younger Peter Davies thought about the market. So that's still on there. Then we've got a link to Guy Bauer's page. For those that don't know Guy Bauer, Guy Bauer is an educator. He was being an educator at PropX. He's also got a few websites, trading-related websites, as in trading. He did leave PropX, but I believe he's now got a new position training at another prop firm. So he's the guy that teaches prop traders how to trade, and he's got a really useful YouTube page that's got drills, it's got live trades. There's not tons of them, but it's got live trades, and it's one of the few places where you'll actually see trades during releases. So that's a really good resource. And again, you're not going to just go through that. I wouldn't say just go through that and watch that all in one lump. It's just something you can go, and just some very good videos. John Grady, this is a presentation he did, again talking about prop techniques. And then we kind of get to some stuff that's the blog. And let me just take you through the blog, because there's some interesting resources that are educational resources on the blog. And we just go back to the slides, so that's probably easier to show there. So there's some other useful content. So there are blog categories, so you can actually just go in and look at the category for thin markets. So if you're trading thinner markets like crude, there are some resources there for you. Some trade videos there, some just general trade videos, some from me, some from the customers. And then we've got some Spanish, Portuguese, and Russian stuff. And then finally, and I will send this, I will put this on the recording, this slides. And finally, we've got the customer-only course, which is the ES When to Enter. So one of the things we always talked about is the icing in the cake, and that in trading you need the cake, which is, roughly where do I get into the market, and then the order flow is kind of the icing on that cake. And we had a lot of people come to us and say, I don't know where to get in. So what we did, we put together a course that focuses on trade location, but really the focus of the course is the way that basically the market gets kind of quieter and more busy, and the way that when a break in the market becomes more obvious, that speculators jump in and those moves become perpetuated. And we call those jokingly in the course sheep. And of course, that's where we get this name for the CSI, the Cumulative Sheep Index, because basically it's that Cumulative Sheep Index that tells us if more people are coming to the market. Now, a lot of people have said to me, is that course still relevant? And I would say yes, because it wasn't really so much about you should buy the market when this and this happens. It's about the whole concept of traders jumping into the market, traders then the market moving in one direction, then those traders start to get stopped out and the market moves the other way. And of course we give you ways to show that so you can benefit it, but that's really always going to be the same. That's not really going to change in the market, I don't think. It's about understanding what's going on in the market. Obviously discuss these trade entry points, but the focus is more on the why than the what. So that is a look at the educational videos. I'm just having a look at the questions now. Okay, let me just go to a question I got in the email. That just makes you sound like a radio show, doesn't it? Okay, this is a good question, and I've got some notes for myself on that. I'm wondering if you can explain in simple terms as to what causes the market to pause. Understanding there's a greater percentage of computer-generated trades, is it actually computers that are set to pause at price levels, or are they set to detect weakness or strength in the price action to continue or not at a predetermined profit figure? And how does the individual trader who trades orders affect this as well? Right, so first of all, about the computer stuff. I don't know if I really buy this concept that computers are trading direction in the market with large targets. So most of the people I've spoken to in the industry that consult to quant firms or own quant firms, it's almost entirely market making, really short-term trading. So we've got this idea, everybody's got this idea that the market is just robots pushing the market around, when actually the robots are actually just scalping for a tick. So that's the first thing. So let's just put the computers to one side for the moment, because again, it's just not something I believe. And again, part of my edge is I believe that it's mostly humans moving this around, and I'm trying to take advantage of them. So the market pauses for two reasons, right? The market pauses first of all on volume. So we get to a point where we start spinning volume, and that is pretty much an aggressive move. So market moves down, we start churning a lot of volume on the bid. Basically, it's a bidder standing up. So in terms of that, that's probably not the kind of pause that you mean. It's a pausing price, but it's not a pause in trading activity. Okay, so a lot of guys that are trading just off charts probably wouldn't see that. So we reach a price, people keep trading, but price doesn't move. So that's your one kind of pause. The other kind of pause is when the market moves and just dies. And there's a couple of places you see this, very much on pullbacks. When the market's moving up, it will then pull back. Markets put a good move up, and it will then start pulling back and just pull back, and then just there's just nobody there, right? There's just nobody there. And if you think about it, so think about, you got people buying, and people are buying the market up, and then we just there's just really not anybody else to buy anymore at that instance in time. The market comes off a little bit. Okay, when the market comes off a little bit, sure, there's probably a few of those buyers that's selling, offloading. Sure, there's probably a few counter trend traders, but you've got all these people that have bought. They see the market coming back a bit, and there's just no interest. And then what will happen? The market will start kind of creeping up, right? The market will creep up, and then suddenly, usually as you get to the point, where the kind of trend stopped momentarily, you get to that point, and then people jump on it again. People will anticipate the stop run because obviously people have shorted. Market's moved up, it's come down. People will have gone short. We know that as we pop through the area where they went short, they're gonna get out of their trade. So people actually anticipate that. It pushes through, and then people get on, and it's a bit more exciting. The market's now moving up again. We've got that excitement, and we're starting to move forward. So for me, when I see this kind of action, when I see the market pause like that, I'm just figuring, it's just kind of, just a lack of interest, or just, people got excited, and just that excitement's kind of waned a little bit. And then when the market starts to march up again, they get that excitement. They want to jump on. They want to participate in the next move, because we know it is easier for the market to carry on than to turn around. We see it all the time, right? So you have to know, and there's got to be somebody trading those continuations, right? So people see that the market's going to continue. That means there's opportunity to the upside again. So I just think when the market pauses, it's nothing more than just a behavioral thing. And again, it's probably what we talked about at the start. Think about other traders' behavior. Think about the market pulls back really weakly. Nobody really wants to sell it. There's no sellers there. Those sellers are going to realize they're toast as soon as the market moves up, and then they're going to get out of the way. And you just see these waves of activity, and that's really what we call the sheep as well. So let me just go through the questions. Low volume in the bonds. If it's a rollover day, the volume can be quite low, but I wouldn't expect it necessarily to be lower. What I would say about the rollover day is the order flow is probably useless on rollover days, because if you think about the rollover, it means people are leaving one contract and going into the next contract. So if somebody's got like a short position, they're going to have to buy the market to exit that short position and sell the other market, right? So there's going to be buying in the market they're leaving that has no, the people who bought are unwinding positions, and they've got no directional bias. They don't care where the market's going afterwards. So on a rollover day, personally, I don't trade, because I can't read the order flow on a rollover day and actually rely on it personally. So I wouldn't expect necessarily low volume on a rollover day, but I would expect order flow not to work. Someone's asking if we've got plans for Sierra. No, we haven't. We've got other plans that will hopefully be released in the next few months. Somebody says, your video trading without charts turned my trading around. That's very, very good to hear, Carl. I haven't seen the check yet, but I expect it got lost in the post. Now, are there any books where we can learn more about order flow theory and order flow patterns? If there were books on order flow, I would not have put those courses up there. If I could have pointed you to somewhere where the kind of information I was giving out was available, I would have pointed you there, because the kind of stuff, if you look at like stuff that John Grady does, some of the other people who teach in order flow, they're very focused on scalping. And so what I wanted to do, instead of like trying to do what they'd done again, is give information about using order flow to confirm trades, because that's really what I do personally. So I don't see anything. I haven't seen anything like that in books. Plus, the other thing about a book would be quite a poor medium to teach order flow, because order flow is something that moves. So it's very difficult to teach something that moves from a book. And when John Grady started out, John Grady first had this ebook on scalping, and I read that ebook, and it could have been written in French or well, I actually could read French, but it could have been written in Chinese, and I can't read Chinese. I just didn't understand a word it was saying. Then when I actually watched the markets for a while, went back to the book, it made sense. But it was just because the written word couldn't explain the concepts very well. So I don't think there will ever be a good book in it. Now, cumulative delta, there's a few places to get it. You can get it off the Futures.io forum, the Gomi CD for NinjaTrader. I'm not sure about NinjaTrader 7, if there's been one built or not. For multi-charts, it's built into the system. I'm not sure there's one for S5 Trader, but basically, there's cumulative delta indicators. You could write one in 5 minutes, but with NinjaTrader 7, you actually need to save the data because you need to know whether a trade was at bid or offer. So with the Gomi tools on the Futures.io forum, those tools don't actually just calculate the delta. They actually store the data that was used to calculate, so that when you refresh your chart, you don't lose the information. God, I hope it doesn't take 10,000 hours because I only have 1 hour of money. Standalone version of Jigsaw. I'm just low on resource at the moment. It should be out in the next couple of months. I mean, it's so close now. So it's just a matter of getting it working and getting the data providers to approve it. Okay, so how order flow would give signs of acceptance or rejection. Well, basically, acceptance or rejection. To me, order flow is giving you direction. Okay, so if you're getting acceptance or rejection, you're talking about basically a reversal or the market going through. So really, that's covered in that first video, the introduction to order flow. But effectively, you've got every single reversal will do one of three things. It will either you'll either see absorption by the opposite side, or you'll see one side fade away, which are two things that you can see in a fairly timely manner. Or the third thing, you'll just see the opposite side coming out of nowhere. So every reversal is a combination of those three things. So that's effectively your rejection. And then acceptance, really, well, for me, acceptance is more of a volume profile thing. So when you look at the order flow, you're really looking at the volume profile and looking at an area that builds a lot of volume. So what you'll tend to see, like on a trend day, market will move up, and then you'll just see one price or two prices with high volume, and that's your heads up. And then just slowly over time, over the next few minutes, it'll just slowly rotate around those prices, and that area of volume will just slowly build up. Okay, so when I see that, if the market's moved up, and I see that, a lot of people will say the market's paused, because what will happen is the market will put in a run, and you'll get a price with a lot of volume, and then it will just rotate around that price and build more volume around that price. And everybody starts selling it because they think, man, the market stopped moving, it's going to go down. But that is effectively acceptance. The market is accepting those prices. It does not mean the market's going to reverse. And, if the market's in a strong trend up and you see that acceptance, it's actually more likely to carry on moving up. So effectively, the reversal part is covered in the first video of Introduction to Order Flow. The acceptance part is the day trading without charts. A live trading room. I'd do a live trading room if I could find the right trader. But we've tried it twice, kind of fell flat twice. I'd have to be very sure about the trader next time. If the standalone version, you're going to be grandfathered in, yes. Don't worry about it. As for Gomi for NT8, yeah, it's funny. With Gomi, I remember contacting him once and saying, people are asking me, can I have my data feeding into... from the reconstructed tape into your Gomi and into your footprint charts, and he said to me, "I don't talk to vendors," and that's all he said. And I find it quite funny. He's now selling software. I kind of never replied to that message, but I feel I should now. I would imagine that I'm surprised NT8 doesn't have cumulative delta built in, but NT8 does have backfill, so somebody will build the cumulative delta. And there's also places like Rancho Dinero that do stuff as well. Do you have an order book indicator that shows the level for both bid and ask with a simple bar graph? No, I don't. The only thing, certainly we don't have over time. Now, obviously, for over time, this is the way that we look at the order flow over time. We do have a snapshot. Let me just find it, where we can show, let me just take those other two off. Another way of looking at it, so if you're looking at it from a snapshot, this is actually showing the ratio of the bids to offers, and you know, you can look at more or less levels. Is that right? Right there. Okay, this one, the depth power meter. Okay. So we don't have a bar chart graphing the ratio over time. It's pretty easy to do though, to be honest. Planned for future releases, we've got some more graphical stuff we want to do, standalone projects. I don't want to say too much because somebody else will do it before us because we're so slow. Yeah, Sierra's got a lot of good stuff. It's just built in a different technology for us, Dion. And so, you know, because the technology Sierra is so different from ours, we use .NET, it's a much harder thing to work with. And we just decided we're doing our own, we're doing our standalone thing later. There's really no point doing any more platforms. Standalone, it's just the same tools that we got now, but you just don't need a platform. Okay, so there's no information on the website because it's not out yet. It's still a work in progress, but that's what we're doing. Anyway, I think we'll probably do questions forever, but I think we're getting to the end of the questions. How many lots can I consider not retail? Well, retail guys can be big, and I think if you're looking for size of trades that are really significant, you just got to really look for the trades that don't happen very often. So I know that sounds a bit of a cop-out, but you know, if you're looking at a market and every trade is one lot, and then very occasionally a 20-lot trade comes through, then it's 20. The number's 20 basically that you should be looking at. Personally, I like to look at 50 and above on the S&P. I think anybody trading 50 contracts probably isn't handing money to the market over and over again. And I know that the other thing about looking at the large trades, they consume more liquidity, right? So they are more relevant from an order flow perspective. It's not just saying that are the big guys on my side. Their trades are going to consume a lot more liquidity. So as long as the big guys are actually getting price progression, then you know you stay on their side. I mean, you can see this guy to some extent here. You've got a lot of big sellers, even down to 87.25 here. You know, sold down to 87, sold again at 87.25. Now we're kind of moving up. You know, you've got to put that in context. Those guys are kind of a little bit stuck now. So, you know, for large trades, it's just what is uncommon. Okay. So I think right on that, I think we can stop. We've gone an hour and 20 minutes. I thought I would talk only for 10 minutes. We will do another Q&A in a month or so. Yeah, if you buy the product, if you haven't got the products, you buy them now, you will get the standalone version. We will grandfather you in. Again, not just because we're nice guys, but because it's easy to support if you all use the same thing. Anyway, so thank you all for coming. I say we'll do the next one in a couple of months. I will put the slides and the video on a blog post and email that out. So again, thank you guys. I do appreciate all your support and all the nice things you've said in the chat and also the stuff you say on the various internet forums. So thank you very much.